Welcome to Inform TV. I'm Alan Repke, Alexandria, Minnesota. Today, this sixth day of September 2012, we're going to look at and talk with the people from the University of Illinois Farmdoc, and we're going to look at an issue that we've talked about here before, and it's in the news big time, of course, and that is crop insurance, and all the talk about this disaster and how unfortunate our poor farmers are, and so on and so forth. But we're actually going to look at some actual hard numbers here today, and we're trying to bring out in the discussion with USDA people all the real issues. And we want to talk a little bit before I get started here too much and get started with the tape that we had the technical difficulties of his location. Skype wouldn't work, so all of a sudden let's do it by phone, and I couldn't get my phone to drag over this far so I'd have a good speaker phone, and he had to get going, so I popped my cell phone out and didn't click up the volume on the speaker phone because I've never really used it before, da-da-da. So all the issues of being a one-man show and in a real army, in a real war, as they say. But anyway, what we want you to think about when you're listening to the conversation that I had with Bruce there at the University of Illinois, and I'm thankful that he talked to me because most don't want to. They don't want to talk about the real issues, and but you'll find it interesting. But it's a hard listen, but you'll see where I'm coming from. But here's what I want you to think about. Here's some of the farm math that we're really talking about here. In the spring now, the farmer and the banker agreed with insurance protection by and large. In the example we're talking about, with 75% coverage of his 180 bushel yield history, and it comes up to $667 per acre, enough to cover his cost of production when you consider they got some paid for land, some paid for machinery, and yes, costs are way higher if they don't own any land and leasing all their machinery and all that kind of thing. But it's the upper $600 area, both some university numbers, some of the numbers DTN has had on, all show that this 767 actually paid for the farmer's expenses and some living expenses, a decent number. But because this reinsurance agreement that was ironed out with some USDA people, all kinds of key farm state congressmen and senators, both Republicans and Democrats, the farm groups, whether they talk about how conservative they are or how liberal they are, they all have their face up into it just under their nose and don't want anybody like Inform TV to talk about this stuff. But anyway, what I'm getting at is you listen to this discussion, suddenly, even though you, the taxpayer, pay 62% of the farmer's premium, and which amounts to almost $7 billion, and in reality, when you look at these numbers, even harder than Bruce and I are talking about, the only ones that really getting exposed big time, and Bruce didn't want to agree with that, is you, the taxpayer. And yet the insurance companies, I have had a real enjoyable experience for about the last 20 years on this thing. In fact, it's actuarial sound. And when we talked here on one of our other deals where if the government's going to take the beating, why doesn't the government just take the thing over and truly make some money on all these good years with the way this system is set up and improving yields and all this. But anyway, what we're getting at in our discussion, the farmer and the banker were all happy with coverage at $767 an acre. Suddenly, with this scheme called reinsurance agreement, and the price is going up, the farmer suddenly finds out he's got $1,080 per acre in coverage now. Yet his premium didn't go up. Nothing changed other than he had the right politicians and the right deceitful people behind the scenes working for him. So when we look at this revenue of $180, and we're talking here dry year now. When we started out in the spring, the government said the trend line yield was 166 bushel per acre. and the farmer and the banker said we can insure it at the 568 price per bushel. The farmer's costs would be covered, and because of all these schemes we're talking about, suddenly this 1,080, even if the farmer didn't go below his insured level, he's going to get some revenue. In fact, he can get some real big revenue even if he's just better than his insurance coverage. And that's what I was talking about with Bruce. So when you divide the spring price with the new revenue guarantee, what's the crop come out in value? It's a 190 bushel crop. Just think about that. And everybody's feeling sorry for these farmers that had good insurance coverage? Not at all. Yet the taxpayers are told this is a disaster situation, and yes, it is as far as total production, but not for the farmer. And we're in a situation here where federal crop insurance has become king, an incredible golden spoon. But in the discussion, I did make two slips that I said I referenced corn at $2.20 instead of $5.20. I did say $5.20 in our discussion. I talked about, and we showed here one of our other meetings where in the spring corn, December futures was $5.68, and then for about a month in June it was only $5.20, and now it's up in that 8+ range, or strong $8 today. And listen to this discussion and see what happens to your government when you don't have a true press like Informed TV asking all the tough questions, but just trying to get in there for you, the taxpayer, who's trying to figure out what the Sam heck is going on. Today we got the privilege of talking to the people from the University of Illinois. Bruce, introduce yourself to the listeners of Informed TV.
Hi, Alan. Bruce Sherrick at the University of Illinois, part of the Farmdoc team, professor of agricultural finance.
75% coverage.
80% coverage or 75?
75, I think most guys are at.
Okay. So that means that they have
135
bushels, and if the harvest price turns out to be $8,
yep,
right?
Yep.
Then they have 8 times $135 or 1,080 of guaranteed revenue.
Yep.
Now, when they harvest their crop, they have to calculate what their available actual revenue is, and if it's less than 1,080, they simply get paid that in dollars. If it's more than 1,080, they don't get paid because that's more than they had. They received more revenue from their production than they had insured.
See, that's my whole point, Bruce. This farmer, all these corn farmers, with this example, and this is going to be a pretty common example, they all started out, when they planted the crop, they had protection for their banker at $767 per acre. But in our example, if the price of corn is $8 in October, suddenly they have
a lot better insurance.
They got $313 an acre more money coming to them than they originally thought. And they didn't pay any more. They didn't pay any more premium.
Pardon?
They didn't have to pay any more premium or anything, but they're going to get their income is guaranteed to go up to at least that level we talked about, $313 an acre.
So the value of their guaranteed revenue increased by $313 in that case. So in order to get a claim, anything below the 1,080 will generate a claim instead of being below 766.
Yeah, that's what I'm getting. And see, that's where I'm coming, Bruce, as far as the total liability for the American taxpayer is not $116 billion as Risk Management Agency published. And they won't give me, as a press person, they won't give me any estimates or likelihood of this is actually what's happening based on prices today. And see, I've told them, I said, this liability, as of today's numbers, is easily $150 billion. It's not $116. You see where I'm coming from?
Well, but it's an irrelevant comparison, frankly.
But it's only relevant for today. Within 30 days, it could be very relevant. That's what I'm getting at, Bruce.
So that's a across all production and all coverage levels and all policies. It's simply an index of the scale of the program. And,
yes, that is. But now back to all these exemptions on this standard reinsurance agreement. When I look at that, Bruce, I see that this state thing makes the insurance companies come out like bandits, because basically they're not going to have any out-of-pocket losses in Minnesota probably, or North Dakota, probably in South Dakota, but probably going to be about wash in Minnesota. Except for the price deal, but as far as yield loss, there won't be much of any, and North Dakota probably won't be any yield loss, but because of the price going up, there could still be a pretty big payout in North Dakota, right?
So a couple of comments. This is going to be a very difficult year on the insurance companies. Not going to be making out like bandits.
They're not, but they're only going to lose, like your Financial Times article pointed out, and Moody pointed out. I think you guys said the insurance companies, or some rating agency said the insurance companies would cost them $4 billion above premium. But they've been taking in about $3 billion, over $3 billion last year, and the way the reinsurance deal works out, and I've talked to a couple people on this, saying anything over after about a 2.2 ratio, I don't think the insurance companies have any exposure, do they?
No, they still do. It's higher than that, where they.
But it's less than 5% of the rate at that place, right?
Couldn't completely understand what you just said there, but the insurance companies will not find this to be a comfortable year, and you can't look at their historic underwriting gains.
But they're not going to have any, catastrophic loss. The taxpayer is going to have a catastrophic loss potential here, but the insurance companies surely aren't.
So you can't look simply at their historic underwriting gains and understand.
But it's been actuarially sound for 20 years.
Reinsurance and the losses this year to the insurance companies will be, for some of the companies, quite a bit more than they had accumulated in any reasonably recent past on underwriting gains. But that's how insurance works. You are supposed to have some exposure to large losses, and the insurance companies definitely won't be making out like bandits this year.
But it looks to me like their biggest loss
is borne by the government under the terms of the standard reinsurance agreement, as you pointed out, and likewise that's intended.
But their biggest potential loss.
Well, let me just finish the description. Under years when there are gains, the government shares in gains. When there are years there are losses, the government shares in losses. And the design is meant to promote the ability to take really large positions because of the high systemic or correlated nature of the losses across agriculture. It tends to be the case that when one farmer has a loss due to weather, a lot of farmers have a loss due to weather. And in order for the insurance market to be able to operationalize that sort of pooling of risks, it was believed, and again, without taking a position on this, the reinsurance arrangement was designed to make it possible for insurance companies to participate in just such a thing.
But,
now, the
go ahead.
size of the loss that goes to the taxpayer in a given year, this will be a big one. There's no doubt about that. And the rates over the long run, though, make it about a wash. The total losses in the program across all crops, across all years through time, again scaled for the size of the program year to year, probably won't look completely out of bounds even after this year.
But for corn and soy,
it's a large number. I don't really I think there's a lot of value in trying to calculate how much the maximum liability number has changed, because the maximum liability number was not going to be hit in any case, nor will a higher calculated maximum liability number.
But it appears what I'm getting at, Bruce, using the numbers we've been talking about here, the biggest liability for the insurance company and the government is going to be, at least in corn and soybeans and wheat too, because I think wheat price is going to be up $2 a bushel over their planting price, right? The biggest exposure is going to be on a price gain. It's not going to be on necessarily on a yield loss at this point in time. Because, for example, we talked that 100 bushel in Illinois, if the guy's still going to get 100 bushel corn, he's only going to have 35 bushel loss times the original price of $5 a bushel is $1.50 compared to the price going up. That's double that. You see what I'm saying?
This is priced into the original premiums, though. This is not free insurance. So,
but the premium, the taxpayer gives them 62% of the premium.
If you look at the difference in premiums between the policies that had the harvest price option and policies that had the harvest price exclusion, you'll see that you paid quite a bit more for the option to have your guaranteed revenue increase.
Probably $4 an acre?
In some places it was $20 an acre difference.
But they're going to pick up $300 in our example.
The cost of the insurance and the fact that the insurance is worth more is very much like having a different deductible on your automobile insurance. If you have a $1,000 deductible, you don't pay as much for the insurance as if you have a $100 deductible.
But on my example on price,
option is an insurance product that doesn't have the same design, and the differences in premiums are designed to cover the cost of that additional coverage.
As far as my example, Bruce, as far as with the price gain, when you look at price gain, the insurance company could have hedged that on the Chicago Board of Trade, and the government even could have hedged that. But we know for sure the government doesn't do any hedging whatsoever. Do they, even though they watch the price go up?
It's not the same proposition as having corn in the ground and saying I'm going to hedge a price when there's an insurance product.
But in reality it is, Bruce, because the price of futures were set at $5.68.
Low yields, and it's not the case, simply not the case that you know how many bushels you're going to produce independent of a price.
But the government knew, as well as insurance companies, they knew exactly how many bushels they had insured. They know exactly what the price was. In fact, the price went down from the original spring price in June. There was basically a month where they could have bought a call for, say, at least 40 cents a bushel and had themselves totally protected on price as well. So could the government, right?
Most economists would not prefer for the government to also speculate to try to offset their exposure to crop insurance, and it's simply not the case that you know how big of a position to take.
Right, but
the start of March. But you can't hedge all of the bushels because you're not going to pay out all the bushels, and then you would have been short the total crop and only paid it back on, say, 15 to 20% of the crop. So
but by the Secretary of Vilsack not doing that, we're going to have a potential billions and billions of losses. Yet at the same time, I would guess the insurance companies either did or sure should have. You see where I'm getting at, Bruce?
No, I disagree. I don't think there's a plausible strategy ahead of time. There's simply not a plausible strategy ahead of time to know how to avoid losses in insurance by hedging just the price side.
But I think in this case they had a golden opportunity to do it the way the market went, because in the month of June they could have bought all the December futures for corn they wanted at $2.20 a bushel, and they probably could have bought an option even for probably 40 cents a bushel and been totally protected on a price increase. And I would guess at least some of them did, especially the ADMs and the John Deeres that know the grain game. You see where?
No, that simply doesn't make sense, frankly. it may seem like it after the fact because you know what prices are now. But at the date that you were suggesting doing that, it was equally likely they would have lost on the strategy of doing that. So it's just not a...
How could they have lost if they already knew their exposure was at 568, but the market went down to 520 for an extended period there in May and June, and all they had to do is either buy the board straight out and watch it go up, or at least when it started to go up from 220, and basically had no cost at all.
Well, I hope you personally did that then, since if that would require you to know that the price was going to go back up to make money doing that strategy. So again, it's just not a business practice that an insurance company would want to undertake, is to add to or speculate on a position on one side or the other.
Yet all the experts have told farmers that for years. All you had to buy at this low mark when they show a chart at a marketing seminar and sell at the high part of it. But anyway, Bruce, I appreciate your time very much. And can you email me at Inform TV some of the examples we talked about? It's very helpful to give me some understanding and my audience some understanding of what's taking place here. It's always good to have.
What I'll do is provide a link to the examples at the Farmdoc website. We have a good series at Farmdoc Daily that has quite a few examples for calculating insurance. And also the crop insurance section of our Farmdoc website also has, for virtually every county in the U.S., every possible cost of insurance and the premium side, and some pretty good information on understanding how the different policies would be expected to pay in the fall.
But after our talk now, wouldn't you have to say that the total liability is much higher than 116 billion, Bruce?
I would. No, I can't really say that that's a relevant question, because the definition of total liability is something that was calculated a while ago. The total calculated exposure, if you take the new price, is an increased number. But I, again, have to point out that what you really should care about is how much we're going to pay out, not what the maximum number is from calculating a hypothetical 0 bushels of crop produced in every single location. That number just doesn't mean anything. As soon as the first bushel was harvested anywhere this year, the maximum liability that you referred to several times here is no longer a relevant number. The estimate of bushels and the related higher price, of course those are negatively correlated, does create a very complicated to predict total exposure for payments that we're going to make under crop insurance. That's the number I think we should focus on. Try to figure out what the total exposure will be in that market. Again, our initial estimate is somewhere around 30 billion. We could be way off. A few folks have come out with slightly higher numbers. Again, some folks have come out with slightly lower numbers. But whether the maximum liability goes up or down or not doesn't change how much we're going to pay out.
Okay, here's the
number that's easy to use to say that the size of the program changed because the price went up.
Here's the example I would give, and this was from the numbers that were given out on Monday, Bruce. The total liability on corn based on the 568 was $44,880,000,000, and then you divide that by 66,890 acres. Well, that's cents per bushel, but I got to do it the other way around. But the total liability for corn shows from the spring price is about $44 billion. In the case of soybeans, the exposure is about 21 on revenue protection, but I think that's all of that's a misleading number, because basically just the yield protection or anything with an R in front of it is going to get some advantage out of this higher fall price, right?
The design of revenue protection that allows the harvest price option is that the value of the protection increases if the price goes up.
Right. So that's what I'm getting at, because the total total coverage, and it's going to just about be all price protected according to the way we're talking here now, and I agree with that. Suddenly, there's $53 billion in liability for this year's corn crop, and what I'm getting at is I think that's probably at least $70 billion, or maybe even more than that. That's what I'm getting at for the total exposure. And I understand all the games this reinsurance negotiation stuff went on to include states to limit the insurance company's exposure, but it's interesting because the soybean crop insured about $25 billion. That's going to be at least 35. In fact, that could be even quite a bit more than that. But it's going to be some really interesting numbers, especially if yields come through on Wednesday, like I'm predicting. They're going to be substantially lower again. And that's where I'm coming from. So I appreciate your time very much, Bruce.
It is going to be a big number this year. We're all in agreement on that.
Don't you say that what you
refer to against that number, I think, is the question. And if we have a $30 billion loss, I'm not sure that I care whether the total liability was 115 or 150. I care much more about the size of the loss. And so, again, calculating a number that's much larger without ascribing to it a likelihood of it being paid out doesn't help me have a more accurate number on the total payout.
One last question.
That means the 30 billion or whatever we turn into for total losses.
The numbers you guys at Farmdoc gave to the numbers you guys gave at Farmdoc to the Financial Times there, were they based on a 568 price, or were they based on a higher price?
They're based on what we believe to be a current price.
So you were looking at probably a $2.50 higher corn price with that projection?
Roughly $8 corn, yes.
Roughly. And what about for price for soybeans?
Again, roughly market prices. I mean, we're
$17.50 then.
When we're at $8.10, we tend to round $8, and when we're at $7.90, we tend to round $8. And likewise for soybeans, we tend to use numbers that are a little easier to calculate than the daily penny movements.
So you were probably using $17.50. But were you in that calculations calculating all the farmers that aren't going to have a claim, or were you calculating just the farmers that you thought were going to have claims on a bushel basis?
We did not add any farmers without claims into our estimate of claims. I may not follow your question there.
Yeah, that you did fall. That's what I thought. Basically, the number you gave Financial Times was based on a yield drop of X for corn and Y for soybeans, but you didn't factor in the fact that there's a lot of farmers out there that are going to have a reduced yield, even here in Minnesota. And so their revenue, or their bushels to generate revenue, they're going to be getting a check from the government as well. Even what I'm saying is anybody under our scenario with corn, anybody above 135 is still going to likely get some pretty good checks. So that's where we're coming at.
Well, again, not sure what you're asking. We calculated what we thought all the claims would be. So anybody who gets a claim, we were including in that payment.
Okay. That. But at any rate, we're going to know a lot more next week when we get the. Because next week they're going to give us an actual field. They're going to count kernels on the cob, right? And count beans in a pod, even, or just pods. What are they doing in the September report?
I don't know the details of their yield forecasting procedures. They're reasonably well developed.
What I'm saying is this September number is going to give us, especially with the advancement of the crop, is going to give us a pretty good look, especially good look at corn, right?
I think the numbers, from my perspective, tend to get more accurate through time.
Right, but what I'm getting at is the fact the corn crop is so advanced because of drought and early planting and whatever, warm summer. The equivalent, the September report is probably going to be equivalent of a normal October report. That's what I'm getting at, Bruce.
Perhaps.
Okay, well thanks a lot, Bruce, for talking to Informed TV.
Okay, thank you.
You bet. Bye now.